High income is not wealth. It is rented stability. In 2023, over 40% of households earning more than $150,000 per year still live paycheck to paycheck. Six figures. No freedom. At the same time, individuals with $3 to $5 million in invested assets generated $150,000 to $250,000 annually without clocking in. Same cash flow, different control. You were taught to chase income. Nobody taught you to measure dependence. Here's the uncomfortable truth. The higher your salary, the more fragile your lifestyle can become. And most professionals never see it coming. In the next few minutes, you'll understand three things. First, why high income lowers your financial awareness instead of increasing it. Second, how lifestyle inflation quietly removes your negotiating power. Third, why salary dependence is the most invisible form of risk. By the end, you will stop asking, how much do I earn? And start asking, how replaceable am I? Write this down. Income is a flow. Control is a structure. Let's break the illusion. The mechanism. Why high income feels safe. You don't love income. You love certainty. A predictable paycheck reduces anxiety. Your brain relaxes. This is called security bias. Humans prefer predictable outcomes over uncertain, but potentially better ones. When your income rises, your confidence rises with it. But confidence is not insulation. Example, a professional earning $220,000 per year. After tax, maybe $150,000. Mortgage, $4,000 per month. Car payments, $1,500. Private school, $3,000. Lifestyle costs, $10,000 plus monthly. On paper, successful. In reality, locked in. Remove income for 6 months. What happens? Income stopped. Expenses did not. That gap is vulnerability. The Henry profile. There's a term for this pattern. Henry, high earner, not rich yet. High income, low asset control. Henry's often upgrade lifestyle quickly, increase fixed expenses, delay investing aggressively, avoid calculated risk. Why? Because comfort grows, and comfort reduces urgency. Let's use numbers. Someone earning $180,000 per year invests $20,000 annually. After 10 years at 7% growth, they have roughly $275,000. Now compare that to someone who caps lifestyle at $70,000 and invests $80,000 annually. After 10 years at 7%, they have over $1.1 million. Same income bracket, different structure. The illusion is subtle. High income hides slow asset growth. The trap, lifestyle inflation. Here is where power disappears. As income rises, spending rises with it. Better apartment, better car, better vacations, better restaurants. This is lifestyle inflation. The tendency to increase spending as income increases. It feels earned. It feels deserved. But fixed expenses are anchors. If your lifestyle costs $15,000 per month, you cannot easily take career risks. You cannot reject toxic environments. You cannot negotiate aggressively. You cannot experiment with entrepreneurship because failure becomes catastrophic. High earners often become more risk-averse than middle-income individuals. Why? They have more to lose. The system rewards this. Corporate structures prefer highly compensated employees with high lifestyle pressure because they are predictable. Predictable people do not rebel. Cash flow versus control. Income is cash flow. Assets are control. Cash flow stops when labor stops. Asset control continues when labor stops. Let's compare two scenarios. Person A, income, $250,000 per year. Net worth, $600,000. Expenses, $200,000 per year. Person B, income, $120,000 per year. Net worth, $5 million invested at 5%. Passive return, $250,000 annually. Expenses, $150,000. Who has more power? Person A looks impressive. Person B is insulated. If a recession hits, layoffs happen. Person A panics. Person B adjusts. This is the difference between earning money and owning systems. Write this down. If your income must continue at the same level to sustain your life, you are structurally exposed. Why high income reduces risk tolerance. Here's the irony. The more you earn, the less willing you are to disrupt it. Loss aversion increases with lifestyle size. People fear losing what they have more than they value gaining more. A professional earning $300,000 is less likely to start a business, switch industries, move to a lower paying but higher growth opportunity, because downside feels larger. Meanwhile, asset owners think differently. They ask, can this decision increase long-term control? They think in decades, not annual bonuses. High income trains short-term optimization. Asset ownership trains long-term positioning. That's a psychological divide. How the wealthy use income differently. The wealthy are not obsessed with income. They are obsessed with acquisition. Income is fuel, not identity. They cap lifestyle growth below income growth. They channel surplus into assets. They avoid expanding fixed expenses faster than investments grow. Old money families often follow a quiet rule. Lie below asset growth rate. If investments grow 6% annually, lifestyle grows slower. That preserves margin. Margin creates optionality. Optionality creates power. Most high earners reverse this. Lifestyle expands first. Assets catch up later. Sometimes they never do. High income feels like power. But if it disappears tomorrow, what remains? If your lifestyle collapses without your salary, you are not wealthy. You are well paid. Income is temporary. Control is structural. The most dangerous illusion is believing a large paycheck equals security. It equals exposure. Because the larger the structure you build on top of income, the more fragile it becomes. Power is not how much you earn. It is how long you can operate without earning. If you want to master wealth psychology instead of chasing promotions, you need to shift from income obsession to asset obsession. Study the structure. Because income is earned, power is engineered.